now for the next edition of CoinMarketCap's Cha-Cha Chats, where I sit down from CoinMarketCap with some analysts and researchers in the blockchain space, and we discuss on-chain activity with some tea, which is also chai, cha-cha chat. Now for the next edition of CoinMarketCap's Cha-Cha Chats, and I can hear myself, so I know that we're actually live. So with me today, we have Lucas, who's an analyst at Into the Block, and we also have Clara, who's an analyst from Kaiko. So maybe you guys can introduce yourself a little bit more before we get into the charts part of the Cha-Cha Chats.
Sure, you can go ahead, Clara, if you want.
Great. My name is Clara. I work at Kaiko, and Kaiko is a B2B cryptocurrency market data provider. So we really specialize in granular trade and order book data sets. But at Kaiko, I am on the business team, but I also write our weekly data-driven newsletter. You can subscribe to it on kaiko.com, but I've really gotten over the past 6 months very excited about how we can leverage our data, especially our market data, to make insights about cryptocurrency markets.
Perfect. And I'm Lucas Outumuro. I'm a senior analyst at Into the Block. We're also a data platform more focused on the on-chain side, even though we also have exchange analytics and derivatives analytics. Soon, some more DeFi analytics. And yeah, myself personally, I've been deeply involved in the space for over 3 years. And glad to be here again, Molly.
Thanks for coming on. So to anyone watching right now, if you want to ask anyone here a question about what they'll be talking about or just crypto in general, you can find us on coinmarketcap.com/chat/cha-cha-chats. We have to log in and ask a question. You can ask a question on YouTube, or you can find us on Twitter, or just beam us your thoughts. And with that, Clara, you can take it away.
Great. So I'll first share my screen. And let me know, all good, you can see?
Yep.
Okay, so Kaiko, we provide order book data. That's one of our most popular data products. And so I thought today that I would present some of the charts that we can make with our order book data. So I chose Ethereum. Of course, Ethereum is one of the most traded assets, but they also have Ethereum USD pairs have quite naturally liquid order books. So it's very interesting to study how the market moves as the price changes. But of course, I chose Ethereum because of the DeFi explosion that happened over this past summer. So there was lots to unpack when studying market data, but also on-chain data, which I think Lucas can provide some more insights on from Into the Block. So Ethereum has had quite a summer, especially as DeFi really takes off. Ethereum as infrastructure, proving it is truly the infrastructural groundwork for a decentralized financial system. But this, of course, makes it attractive as an asset. So Kaiko, we provide market data. And so market data is very important for investors investing in Ethereum as an asset. So I decided to take a look at liquidity for Ethereum. And I think, of course, it's interesting to talk about liquidity, especially because this word has been thrown around a lot, especially since DeFi took off. I want to broadly define liquidity before we get going. So how liquidity is defined specifically in traditional financial markets is the degree to which an asset can be quickly bought or sold on a marketplace at stable prices. And these prices must ultimately reflect the intrinsic value of this asset. So to understand liquidity, we really need to understand how market orders, which are placed by price takers, affect the price of an asset. So trade volume is not really enough to get a full picture of liquidity. In fact, there's no single measure that gives the best indicator of the liquidity of an asset. Rather, it's the combination of many different measures, and most of them actually from order book data. So that's why order book data is actually one of our most popular data products. So today I will present 3 different measures. Hopefully I have time to run through all 3, because I really believe that you can't just look at one when studying liquidity. So the first one that we're going to look at is Ethereum market depth. And what I did here is I charted this yesterday, and I took the market depth for Ethereum USD and Ethereum Tether pairs on 10 exchanges. And I selected a wide range of exchanges just so we can see how liquidity differs based on both the currency pair and on the exchange that the currency pair trades on. So what I mean by market depth is simply the cumulative quantity of bids and asks on an asset's order book. And so here I take just the sum of the bids and asks For example, for Huobi, the sum on April 19th was 15,000 Ethereum. And I take the 7-day moving average just so the line smooths out a bit. And with this moving average, you can actually better observe trends in order book liquidity. So how is market depth and liquidity related? Ultimately, assets that have more market depth on the order book tend to be considered more liquid. And this is because it is actually easier to exchange an asset at stable prices, which means it's easier to buy or sell, as simple as that. And so the more market depth, typically the more liquid the asset. And why would market depth change? We can see in this chart, I've charted market depth for 10 exchanges, 10 Ethereum pairs on these exchanges. But we see it's quite volatile. It moves up and down, and then it falls a lot. So market depth is ultimately very reactive to the price of an asset. And this is because market makers are the ones that actually supply depth to an order book. Market makers need to manage risk. And when there's price volatility, they need to manage this risk by sometimes removing market depth from the order book. So market makers are ultimately the liquidity suppliers. And when you see a change in depth, this simply means that market makers have perceived a change in the supplier demand of the asset, meaning that they're going to change the market, the amount of bids or asks on the order book. And right here, I've charted the price of Ethereum just so we get an idea of how Ethereum's wild summer took off. We see from April 1st until September, quite a lot happened in this market. April was the aftermath of the March market collapse, where we saw a complete decimation of both order book depth and ultimately the prices of these crypto assets. And so in the following months, we see a slow buildup of market depth. Volatility really tones down. Actually, during the summer month, there was very little price volatility at all. Nothing was really happening until the end of July. And suddenly we see a huge decline in market depth. So what happened? Here we can see the price of Ethereum started to go up. And of course, this corresponds with the rise in interest for decentralized finance. And so we see a clear correlation between the price of Ethereum and the corresponding decline in market depth. So that makes sense. Market makers do not want to be caught in a volatility swing. But it doesn't fully answer the question as why there was such a drastic decline in market depth. And it's prolonged. It actually has not gone up. And even though the price has sort of stabilized since, we've seen a couple of falls, especially at the beginning of September and this past week, but market depth has stayed pretty consistent. So I was speaking with my colleague the other day, and we actually thought that maybe this has to do with DeFi protocols. Perhaps these market makers on these exchanges are removing their Ethereum from their order books, and they're actually moving them to decentralized protocols. Maybe they think that it's more profitable to do so, but the correlation is quite perfect. There's also a rise in transaction fees that can be one contributing factor. Ultimately, when it comes to liquidity, there's never really one answer as to why the market depth changes. It has everything to do with market forces, to more like on-chain events such as DeFi that are happening. And so it's really unclear as to why market depth fell so much, but can be quite a few theories. And I guess more research is needed to look into that.
I actually have one.
And so the next
already, sorry to interrupt, just keeping it live. Someone from the CMC chat, Ethereum to the Moon, wanted to ask you how come depth goes down when volume goes up, like in August and September?
Yep, so this has to do with price volatility. So market makers, their job is ultimately to manage risk. And when there is price volatility, it's no longer profitable to be a market maker because you actually lose money. You're typically on the wrong side of the trade when you are trading against informed traders. And say the price is going up, it's clear that there are informed trades happening. And so market makers will sometimes just determine, okay, it's time to pull out of this market. It's no longer profitable. I'm removing all bids and asks from the order book. And I don't have the data from March when the market collapsed. That was a few weeks before, but we actually saw the sharpest decline in market depth, I think, that ever happened in cryptocurrency markets. Market makers pretty much said, I'm leaving, this is no longer profitable, I'm waiting for price volatility to go down. So that's why even when the price rises, it is not uncommon to see a corresponding fall in market depth.
Interesting, thanks.
Okay, and so the next measure I chose was bid-ask spread. So this is very closely related to market depth. So typically, the wider the spread, the less liquid the market, and the narrower the spread, the more liquid the market. So why is that? market makers ultimately are the ones that determine the bid-ask spread. And so when there is actually not that much market depth on the order book, this is a riskier market to serve as a market maker for. And so spreads tend to widen. So it's all related. When there's less market depth, spreads tend to be wider. The more market depth, the narrower the spreads, which means that there's just more market makers, so less risk. So when we're talking about liquidity, we always have to talk about risk. And when we're talking about risk, we always have to think of market makers, and it's their job to ultimately manage risk. And so here we see the bid-ask spread for, again, the same group of exchanges. And it's quite expected, the behavior that happened. Spreads fell quite significantly throughout the summer months. And this was due to very low volatility. So being a market maker was actually quite profitable. When prices are stable, you pretty much just can easily make money off of the spread. And so spreads narrowed. And however, towards the end of July, again, that's when price volatility started up again. We see a corresponding rise in the bid-ask spread. And so the spreads remain quite volatile through September, and there has been quite a bit of Ethereum volatility as fall has started and the summer of DeFi sadly seems to be coming to an end. Okay, so that's bid-ask spread. And the last measure I want to explain is price slippage. So this one's a little bit more complicated to understand, but I think equally as important when it comes to assessing the ultimate liquidity of a currency pair. So price slippage is simply the difference between the expected price of a trade and the actual price of a trade. And so this, again, is closely tied to market depth. When there is not enough bids or asks on an order book and you want to make a large market order, sometimes there's simply not enough depth to support this order. So the price slips. And that's what it means by price slippage. So this is measured as a percentage. And so you take the percentage difference between the price you see quoted and the price it takes for bids or asks to actually fill your order. Price slippage is bad. No trader, no market trader wants to encounter price slippage. So price slippage tends to indicate that liquidity for a given market is not that great. So high price slippage is associated with illiquid markets, low price slippage, more liquid markets. And again, we see a very similar trend happening as what happened with bid-ask spread. And here is the spread chart again. We see high price slippage in the aftermath of the March market crash. This price slippage falls gradually throughout the summer months. And then we see a quick rise in price slippage at the end of July when price volatility increased. And this volatility in slippage has also, I guess, happened over the past few months as well. So those are the three measures that Kaiko provides for measuring market depth, or for measuring liquidity. And just to summarize, we have market depth, we have bid-ask spread, and price slippage. And if you're a market maker, you will always pay attention to these three metrics. You always need to understand the liquidity of the market you're trading on. Price takers should also pay attention because it's very important that you understand when making a trade if you will actually encounter price slippage. And yep, those are my charts. So any questions are welcome.
Thank you for sharing. I will just ask one again from ETH to the moon while Lucas collects also his thoughts. ETH to the moon asks, can you talk more about the DeFi summer coming to an end? If you could walk through the metrics again that suggest this.
Okay, well, I mostly was referring to the collapse in DeFi prices that happened this week. And not that it's coming to an end, it's more that when the prices fall, this tends to, I guess, dissuade more traders from partaking in these liquidity pools. So who knows, it's definitely growing, and I'm quite fascinated by DeFi in general, especially when it comes to liquidity, because you can actually, anyone can provide liquidity. You don't need to be a sophisticated market maker. I guess this is why it's called lazy liquidity. You can simply just put your assets into a liquidity pool and then earn money while doing so. So it's a very interesting and different way to providing liquidity compared with on centralized exchanges. So that's where I think DeFi is very cool. So I don't think it's over, of course not. It's more maybe that it's very important though that people pay attention to these price swings, because ultimately it does affect retail traders and they're the ones that get harmed, I guess, for the long tail of crypto assets.
Yeah, I was actually going to ask you something along those lines because you touched on how DeFi is essentially being like an indirect competitor to centralized exchange liquidity, and not just DEXs, but other DeFi protocols. So I wanted to hear your thoughts. You've touched on them briefly on how DeFi can continue to essentially compete for ETH liquidity that's being supplied originally just to centralized exchanges.
I actually don't think that DeFi is a direct competitor yet to centralized exchanges. And this is for simply the issue when it comes to price discovery. So the reason why you have market makers and price takers on an exchange is that they interact, and this ultimately determines the price of an asset. Right now, for DeFi protocols, they have many of them are automated, and that's what's called an automated market maker. Not all of them, but with an automated market maker, you no longer have these informed market makers providing quotes for an asset. Rather, this is automated. So how does price discovery happen? It happens when arbitrageurs come in and they correct for these prices. But how do they correct? They actually take price feeds from centralized exchanges. So DeFi needs centralized exchanges right now because the biggest DeFi protocols are actually relying on these external price feeds, and there's no real price discovery happening on a lot of these liquidity pools. And so I don't think it's directly, they're in direct competition. Rather, they feed off of each other because the price discovery is primarily happening on centralized exchanges right now. And I don't think that's going to change in the near term.
Interesting. You touched on also how essentially centralized exchanges provide the feeds, so through oracles to DeFi and DEXs. I don't know if you heard about this that happened like 3-4 months ago, but I believe it was Bitstamp's price feed that was manipulated, and it cost on BitMEX, which used them as their main data feed. It caused like a massive liquidation because essentially the feed of the data ended up having less volume than the providers, than the derivatives. So do you think this could be possible as well to flip in a way, as the crypto community likes to put it? So as in like a DEX surpass the volume of the underlying price feed being provided. Does that make sense? And do you think it's a threat?
That makes sense. I think in general, when you use an external like price feed, there will always be a risk of manipulation because it ultimately depends on what markets you use in that feed. And so like, for example, especially on derivatives exchanges, they will always use a price feed to like price the derivatives contracts. And so if you happen to be able to manipulate this feed simply by doing something nefarious on one exchange, this can ripple throughout the entire markets. And like you mentioned, there can be many liquidations on BitMEX. For DeFi, the same thing can happen, especially with price oracles. If there is one problem with the price feed, this can also affect how these prices are getting relayed to these smart contracts. So I'm not sure, I guess that's like a problem that is still being worked on. And I think one of the answers is ultimately more liquidity. The more liquid markets you have, the more difficult it is to manipulate these markets. And it's a lot more difficult for a single market order, no matter how large, to change the price of an asset.
Definitely. And yes, I guess that's the trend we're on based on your price slippage chart.
Yeah, and we see price slippage is falling, even though there has been quite a volatile, I guess, few months. It's nowhere near as high as March. March was insane. I think everyone knows that that was not a pretty time for cryptocurrency markets, but it's good to see that maybe, hopefully, these markets are becoming more immune to these huge volatility swings, and this might be because people are better able to manage risk.
So I'm going to hop in with another question about something you haven't talked about yet, also coming from our audience. Someone wrote to us, so what happens to liquidity when Ethereum 2 staking comes? The more Ethereum is locked up, will that equal less liquidity?
That's a good question. Some people, I just read an article about this yesterday about what will happen. Well, because the supply goes down, this could cause the price to rise, which I think just because it won't actually put that big of a dent in the overall Ethereum supply. If the price rises, then this, I guess, would bring more trade volume. But in terms of market makers, it's ultimately their decision where they want to put their Ethereum and make money off of their Ethereum. So yeah, that's also a risk. But I think it's an equal risk, whether market makers place their Ethereum into DeFi protocols or whether they stake them on Ethereum 2.0. I don't really have an answer or a strong opinion right now. I think it's more of like wait and see.
Yeah, I think it's definitely going to act as an indirect competitor, again, similar to what I was saying with DeFi and AS. And already we see exchange flows point to Ethereum leaving exchanges. Mm-hmm. So I wouldn't be surprised if that trend accelerates to a certain extent once staking is live.
Yeah, and it makes sense. Like to be a market maker, you have to put it's a lot of effort. You're not simply just, I mean, it takes a lot of research. I mean, you have to understand these markets very, very well. Whereas for DeFi, it's just lazy liquidity. Once you put it in there, you don't really need to do anything about it. I guess it's a bit more complicated when staking for ETH 2.0, but if you're looking for the best returns for doing the least amount of work, then I think they're all both market making on centralized exchanges, DeFi and ETH 2.0 staking. At some point, they will all sort of compete with one another.
So just continuing off of this then from the audience, so like as a market maker, how much yield then are they making on centralized exchanges now versus DeFi or Ethereum 2 staking? So he clarified, what's the threshold for them to be pulling liquidity from exchanges?
Well, I think it's first important to understand how market makers make money. So there's three ways. First, they're either paid by a token team. Let's say a token is launching and they need some liquidity on an exchange. They'll pay a market maker to provide this liquidity. So that means the market maker will always provide a bid or an ask. Or will always provide a quote. So then there's a second way, the exchange pays the market maker. And so this is if an exchange is also looking for liquidity, because currency pairs, they always need a counterparty to the trade. And so it's beneficial for an exchange to hire market makers to provide this liquidity. So those are two ways. The third way is the market maker themselves are profiting off of the spread. So there's no like yield when it comes to market making on centralized exchanges. Rather, the profits are made through the difference between the best bid and the best ask. So ultimately, price takers are getting a little bit worse prices because they're buying at a higher price than the market maker is buying, and they're selling at a worse price than the market maker is selling. So the market maker profits off this tiny difference in the bid ask on the in the bid ask spread. And when there's thousands and thousands of trades throughout a day, this actually adds up. So it becomes profitable for a market maker to provide liquidity this way. So those are the three ways market makers make money. As far as I know, there's no yield on a centralized exchange.
True.
Not yet.
Yeah, I was gonna say not yet. Who knows what people are gonna think of next. Let's see, we have another question from the audience here. Maybe you addressed this, so if you have, you can move on. But is on-chain liquidity impacting order book liquidity on exchanges?
That's a really, really great question. I would say maybe Lucas, you're better able to answer this because Kaiko, we're a market data provider, but I'm a huge fan of Into the Block's more on-chain analytics. So we don't currently have data for on-chain, but I know that there's a huge link between, say, the number of Ethereum moved to exchanges versus exchange outflows and how that ultimately affects the liquidity on these exchanges. So I think a combination of both market data and blockchain data can create this like much broader definition of liquidity. So I'm not really sure the answer to this question, but Lucas, maybe you know.
Sure, definitely. I'll share my screen to point out a few things that I have been noticing. Can you guys see it now? Okay, so couple of things. They're definitely interrelated, and we see, so at Interblock we have this indicator, large transactions volume, which is filters essentially on-chain transactions with a total of over 100,000, and it aggregates them to calculate the volume, which is sort of a proxy for essentially whales and institutional player volume. As we can see, and I actually hadn't thought about it until Clara was showing the data. Here we can see large transaction volume spike just as the price breaks out, and simultaneously, I think we saw liquidity indicators drop during that time as volatility took off. So it's definitely interrelated. Here we can see potentially more whales selling at the top or near the top. So I think you showed also liquidity dropping there as market makers were probably less profitable during that time. And I also loaded this indicator, which also kind of aligns with the general trend. So this is exchange flows, so the amount entering, so the inflows minus outflows of Ethereum. And we see here in the drop, we see a massive outflow relative to inflows. So I wouldn't be surprised if that's, well, no, it's not that I'm surprised. That's actually what's happening. That's ETH leaving centralized exchanges during that drop of about, I don't know, 15% or so in those days. So we've seen this pattern of more ETH flowing out of exchanges. And I'd be very interested to see how it progresses once the market matures and ETH 2.0 staking is live.
So are Ethereum miners fees actually impacting liquidity, which is another audience question? Like, are miners doing things with all of the Ethereum that they're getting from fees right now?
Well, I thought when I was looking at market depth, I thought it would be interesting to better understand how transaction fees ultimately affect the liquidity on these exchanges. For example, if it just becomes prohibitively expensive to transfer your ETH from your wallet to your exchange, will that actually disincentivize people from making markets on Ethereum currency pairs? And I'm not really sure. I think it's a question that there's like will be very difficult to prove that that's happening. There more will be like correlations between market depth and transaction fees going up, which we saw. But of course, this is also at the same time as DeFi. So I'm not really sure, but I also had that idea, and I think it could be interesting to look into.
Yeah, it's hard to tell because it definitely disincentivizes smaller players and makes them unable to transact their ETH once ETH fees are that high and gas fees. So I would imagine smaller miners are essentially unable to transfer or unprofitable to transfer their ETH when there's spikes in fees like the ones we saw once Uni was released last Thursday.
Yeah.
But I do not have concrete data on that. That's just my inference.
You need a bunch of different measures, both on-chain and market data. So maybe we should work together, Lucas.
Sounds great. Yeah, there's definitely a lot of room for improvement and connection between these fields, which are just being developed.
Yep.
Exciting at the same time.
So we have time for one more question, which I'll ask. And also, based on what you guys are saying, maybe you guys have already thought of a new topic for another chat series. But so this last question, same from our chat, is do you guys have thoughts on Ethereum layer 2? If more on-chain activity goes to layer 2, how will that affect Ethereum's liquidity? So.
Do you want to go ahead or should I?
Yeah, I mean, I would say that's a similar question. I think there will definitely be a long waiting period where people will just sort of see what happens. Because I guess once you go over there, there's no going back, at least in the short term. So that is very interesting. I mean, I would say wait and see. I don't really have a firm opinion on what will happen. All I know is that I will be looking at market depth to see if there are any changes.
For me, on the on-chain and definitely on the DeFi and dApps side of things, I would definitely expect, at least for dApp activity that's involved with smaller transactions, I would definitely expect to see at least a spike in transaction activity in those that have smaller transactions. So right now you would lose money if you try to buy an NFT for $10, just because that's how high fees are. So I would imagine, and I wouldn't be surprised if transaction activity for these smaller, less liquid type of protocols increase once layer 2 solutions are adopted. But again, centralized exchanges manage certain so big quantities of money that the fees aren't affecting them that much as a small protocols who will benefit the most from these L2 solutions.
I agree. And I think also DeFi protocols too will probably benefit because yeah, if you're a market maker, you're probably keeping all of your ETH on the exchange. And especially if it's like your job and you're doing it every day, you're not moving your Ethereum around that much. So as long as it's on the centralized exchange, you don't have to deal with the transaction fees. It's only when you exit the exchange. So for now, I agree. It would be smaller applications that will most likely be affected.
That was our last question. Thank you guys so much for answering so many questions. A lot of them about the future, unpredictable, but a lot of them obviously that you have the evidence to show us. So I guess to sign off, you guys can tell us, the audience, how people can find you on Twitter if they want to, see more of your analysis in the future.
Yeah, sure. So you can read my weekly data-driven market commentary. Simply go to www.kaiko.com, scroll all the way to the bottom, and you can sign up for our weekly newsletter. It's purely research and data. So definitely do that, or you can follow us on Twitter at Kaiko Data. That's Kaiko, Kaiko.
And for me, well, you can follow my content and Into the Block's content broadly. We actually have a weekly kind of newsletter with CoinMarketCap, so you can find that in their blog, and also through our Twitter, my personal Medium page. I write every now and then, as well as my Twitter. I don't tweet that much, but I try to keep it insightful. So feel free to follow Into the Block. And well, a pleasure being here and discussing this with you, Clara.
Yes, you too. Thank you so much, Molly, for hosting us.
Yeah, it was nice to meet you guys. I'll end with a plug for CoinMarketCap Alexandria, which is our new educational portal. So if anyone out there is watching and heard terms they didn't understand, like staking or liquidity or Ethereum, you can go to coinmarketcap.com/Alexandria and you can read some articles, one of them written by Lucas, about what's going on in the crypto space right now. So now we're really done. Again, thank you and hope to see you on another Cha Cha Chats. Bye, everyone.